management of Redington is with us. Rajiv Srivastava, the managing director, is here to walk us through the outlook on the demand trends and whether or not the supply chain is still under pressure. Thank you so much for taking time out. To begin with, your LED IT services market fell about 33% on account of the transition from work from home, now back from office. At the same time, back to office saw IT demands remaining robust. So what kind of demand trends are you seeing?
Pick up my pen. Yeah, good morning and thanks so much for the interaction. We've seen a softening of demand on work from home and learn from home. Both of those categories have softened, and that reduction in demand, and there was a reduction in the IT overall market size of PCs and laptops and PCs overall across the globe. But that got more than made up by a significant increase of very robust demand for data center infrastructure products like servers, storage, network, software, products being put on the cloud, and largely led by the fact that the desire of the organizations to continue their journey on digital transformation, becoming more efficient and productive continues. So we're seeing a very, very robust pickup in demand from the enterprise side of the business very strongly. Mobility is very strong as well. I think Apple did a launch in the month of September, October. That led to a significant growth in demand, as well as some of the other brands which really had very great products coming in. So overall, the drop in work from home, learn from home has been more than made up. And we had a very strong, robust growth in Q3 of 31% globally.
Sure. Rajiv, your top line growth this quarter was ahead of expectations, right? But your margins contracted by 40 basis points on a year-on-year basis. What's led to this dichotomy, and how do you expect then the margin profile to shape up going forward?
Oh, it will shape up. I think what we are going through right now, and there are global financial reasons that is leading to what you just mentioned on the margin profile. We had a record revenue and we had a record operating profit quarter this year. It was the highest ever in the history of Redington, and the operating margins at EBIT at 2.9% has been very, very, very strong for us. Obviously, you understand that, and you know that the interest regime has hardened over the course of last couple of quarters. It continues to harden in India, in Middle East, in Africa, in Turkey, in South Asia. Pretty much all the markets that we operate in the emerging geographies, almost about 40 odd countries. So that's one. The second thing which led to this sort of a pressure was there was a bit of a inventory buildup that took place in both a bit in consumer, but a lot in project inventory, because the supply chain situation still needs to get a lot more streamlined, a lot more easier. And so if you don't have the balancing equipment to supply to a complete end-to-end project, you carry that inventory, and we as part of a corporate governance policy, we make all the right provisions. So I think is led largely by that, and we hope a lot of it to be coming back to us over the course of the next couple of quarters.
Okay. Given that working capital has been a concern for the company over the past few quarters, your net working capital is normalizing at 30 days now. So is this, what is the outlook that has led to this kind of a rise, and how is it expected to shape up in the coming quarters?
I think our guidance over the last 2 quarters in all my analyst meetings, we have said the working capital will normalize to around 35 days, 28 to 35 days. This quarter stays at the early part of that predicted curve that we have been guiding. So at 30 days, but it will go up. The working capital will continue to rise because that's the nature of the industry. Projects are becoming larger and bigger and longer duration, and we got to make sure that we balance our account receivables and account payables in a very good way. But if you go back to the times which were pre-COVID or around 2019, 2020, the working capital was in the range of 45 to 55 days on a good or a bad quarter. And right now at 30 days, it is extremely healthy. We feel very comfortable with where we are right now. We see it going up, and we got every way in which we can manage the working capital that we've got in the business.
Okay. Tell me about the buzz on Make in India and iPhones now being made in India. Directly, how does this stand to benefit you?
I I think what will probably happen is the inventory situation or the supply situation for the country could over time become better. But all these global companies, you would know that they manufacture in India for the world. So it's not as if they do a disproportionate allocation to a single country, but they do allocations on the basis of demands that come up from across various regions. I'm hoping that just the reason that supply chain will become easier, it is getting manufactured over here in larger quantities, so you can get faster shipments, faster deliveries, and over time maybe you will get a disproportionate allocation too. I'm hoping that that happens, and then you will see a significant rise on the mobility offtake in the Indian market as well. And that's true for most companies. Samsung does that, Apple does that, and there are other companies which are trying to align and make sure they lean on or they ride on the curve of Make in India, which is going to be beneficial for all of them. And the schemes are helping them become more profitable. So I'm thinking that over time, supply chain will become better. You will get faster delivery of products, and the market over time should expand.
Right. Also wanted to understand a little bit, better the supply chain issue and whether you are getting or, whether it's easy now when it comes to bulk orders because much like any other industry, I'm sure you also grappled with, chip issues, for instance.
So right, and we did grapple with the chip issues for a very, very long time. Over the last 2 years, there was a significant constraints on chip demand, sub chip supply, and so pretty much every part of the IT ecosystem, which is PCs, laptops, servers, storage, networks, everything was impacted. And in the last 1.5 years, what we've seen is gradually the supply situation has become much better. And today, we don't have any constraints on chip supplies or equipment supply in PC, laptops, server, storage. So that part of the ecosystem has become so much better and is getting rightly supplied. There still continue to be some supply constraints in equipments in the networking space, especially high-end networking equipment continue to be under under supply constraints with a very robust demand. And so what happens is when you do a large project, which includes all of these equipments, so any typical large project in the government space or in the manufacturing retail, each one of these projects requires the entire IT, all the IT products to be delivered. And if you have a mismatch, these lead to delays in execution of projects. So we are continuing to see a bit of that on the back of networking supply delays. My interaction with the global providers suggests that it is close to coming to an end. I think we will see a real reduction of this, very significant reduction over the course of next 2 quarters. So all the equipment becoming all good, largely the network which is still constrained, next 2 quarters should be fine.
I really appreciate your time. So glad you could join us. What do we have on the markets